question. There is one elephant in the room that actually no one addressed before. Who from you knows travel rule? Who ever heard about travel rule? So there are some hands. How much have you heard about travel rule yesterday? And this is one of the key regulations that actually will allow us to interact with stablecoins across the globe. So my topic is actually about this paradox that we have in terms of stablecoin adoption. But before I will bring you on the topic itself, let me bring you a bit of history. 3 dates, 1975, 1995, and 2025. They have a lot of common in general, because those 3 logos that you see, CompuServe, Prodigy, and all, was email providers that had been established in the 90s. And imagine that the left part of the auditorium will use Microsoft emails, and the right part will use Gmails. And you wouldn't be able to exchange emails between each other. That's how it was working before. Basically, Telegram users sending to Telegram users, WhatsApp to WhatsApp. Before, in 1995, SMTP protocol came out and standardized messaging for everyone. So we started to be interoperable. And it is hard to achieve the same way as it is hard to pronounce. And this is where we're actually heading, because without that, we wouldn't adapt stablecoins in the full manner how we could truly have it in the future. So the paradox of today, actually, that we are reaching out incredible numbers in terms of the volumes. Some projection says that it's going to be 45 trillion moved on the stablecoins this year. True that majority of that is related to the trading, and only few trillions right now could be assigned to the payments itself, but it is super quick. We can send $10 million across the chain for the fraction of cents, fraction of seconds, but yet we can't identify who is on the other end of the transaction. So if I'm a European institution and I'm trying to get money from someone unknown, I literally can't know who is that. And what we see right now, that actually, despite the fact that we have everything right now in our hands, including the regulatory frameworks, and the whole de-risk, because there is already Visa, MasterCard, JP Morgan, everyone playing this huge game, adoption is still kind of stalled in the walled gardens. And those logos of the banks is actually showing us right now that all of those banks have told, hey, we have announced stablecoin accounts for our users. And then there's the question, okay, can I send it anywhere across the globe? Easily, cheap, and fast? And answer is no, only to your own wallet. And then okay, I already have a wallet with you. What's the sake is to just unwrapping with you, what I'm going to do after that, etc. Main reason behind that, again, because there is no IML data layer exchange, so we can know who is on the both ends of the transaction. Because the global adoption is where stablecoin finances will be infused in the fiat currency finances in a seamless way, only after de-anonymization of all transactions. That's what we need, so it would be equal to the fiat. And I'm actually experienced that 2 days ago, trying to pay to the African business $5,000 from my Revolut account, where I have converted dollars into stablecoins with 0 costs, which they announced also recently. And I've told, okay, I'm going to pay to someone else. It's a business. It's also a Bybit account, so it's legal. And I was trying to click save and send, and I was told, no, you can't do that. We wouldn't allow. And after that, I've just clicked, okay, this is my wallet. Yeah, transaction went through. So I've paid $5,000 by lying to my bank, actually. And again, reason behind that is because they can't pass IML data. They don't friends with Bybit Global, and they have no idea who is this wallet behind. So what we actually have right now is 4 things that are blocking this adoption. First, compliance is broken. Second one, liquidity is super fragmented. Then transactions are irreversible and privacy is exposed. So what we have actually is pretty well imagined here. We have 2 people. They see each other, they have everything to partner and work together, but there is a glass wall. And that's what we see right now. And I will try to address and right now go through all those 4 separately. Let's call this person John. It's a compliance officer in the financial institution. That's his face impression when he's thinking about the travel rule adoption, how to use it, and what to do with that. Basically, 100 countries already adapted travel rule. It clearly says that with each payment on the Web3 wallet transactions, we need to know who is the beneficiary and who is the sender. Problem is that despite the fact that of many implementations of the products like Nota Bene, Tracer, and others, there is still blank fields sometimes. And in many cases, they just not interoperable because it's, again, different frameworks. What is happening that, reason behind that regulators told, hey, you need to have a travel rule solution to be regulated and get licenses. For example, in Europe, that's what happened. So everyone ran after the nota bene to buy their product and implement that on the technological level, but on the lowest tariff. So, and then again, we have those walled gardens when companies only send in first-party transactions. So you don't need travel rule because it's from yourself to yourself. And in that case, this implementation looks like a bit fictional, but we need to get to the point where travel rule will be broadly adapted and exchanged. Second thing is, this is another John, and this should be like the face of your CTO or face of your treasury manager, because even yesterday on the panels, we've seen 3 stablecoins pegged by ZAR. There are going to be more stablecoins pegged by ZAR, and in each local currency probably. Each of them going to have 10 chains adapted, and then imagine being like a South African bank who wants to have 100 endpoints where they store in the liquidity. And it's a totally different game, because before, in the banking system, it was one IT system, one server, one Excel spreadsheet, where you're just writing down numbers back and forth, and it cost you 0. When you're working on the blockchains, you're moving real money back and forth. You always pay gas. It's totally different level of the liquidity management, and I think many financial institutions haven't yet understood what it will take them to get and adapt to that. Another thing is, there is no undo button. Again, this is John, he has 3 hands. It's an AI-generated image, but I think it's really describe what also blockchain have as a parameter. I don't know if I will ask you probably if you test transactions, if you do test transactions before sending to someone's wallet. I'm always testing that because I'm not sure if I sending to the right way or not. And once I've lost money by mistyping 0 and O, after that I hate those numbers in letter. But in general, it's really bad. And I think any CFO and treasury manager who's sending big chunks of money and risking that really doesn't feel secure when trying to do such transactions. So for the blockchain, smart contracts, all of those issuing things that should be public and protected, it's a good thing. But for us, as a consumers, it's not. And for the banks, for the operations too. This is another John Doe. You might not notice him, but he is here, and he is tracing Etherscan, SolScan, all the public chain scans for the different reasons. It might be advertisement, behavioral analytics, it might be for the sake of scamming you, and this is where I see actually a big clash of the interests. Banks have promised us, when we were signing contracts with them, that they will protect our privacy of transactions, for what we are paying, how we're using our money, etc., etc. And by using public blockchains, we're actually exposing those data one other way. So there is a clash of interests, how to resolve that. But competitors can see every transaction you make. So what we see next is basically that, why it's happening. And we have a force of or gravity of the current businesses. And I think big players like Visa, MasterCard, JP Morgan, they have huge community of their current clients, and if you're offering the product that is just better than what you do, it's easy to do an upsell or cross-sell. Much easier than do something that is not related directly to your business. And what we see right now that Tether is competing with Circle, Tether issuing new stablecoins in US, saying USAT and USDT going to be compatible. We're never going to be compatible to USDC. Everyone is trying to catch as big market as he can, because we're in this first stage of the adoption curve where really everyone needs to hunt for their own business. So issuers push stablecoins, foundations push blockchains, and orchestrators at the moment taxing this gap. Because what they see that there is so many fragmentation in terms of different API implementations, and they say, okay, we're just going to simplify it for you, it would be very useful, etc. But we see the future where all financial institutions will adapt stable coins internally on their own infrastructure. That was, Ivan was saying that it wasn't the case actually 2 years ago, but in 2 years in front of us, we'll see many, many financial institutions that will adapt stable coins. They will pick infrastructure, Utila, Fireblocks, Copper, whatever. They will directly work in with Tether and Circle. And this is the cheapest transaction that you can make. Just swap fiat money to the stable coin, either local one or international one pegged by dollar for the 0 costs. And then it's a question how companies can interoperate. 1995 is when SWIFT fixed this problem for the banks, because it was looking absolutely the same 50 years ago. Banks was building 2-node connections to each other, partnering directly. They were using telex analogy of the telegraph, sending messaging in a different formats to each other. We're going to send you so much money, you put it on your ledger, etc., etc., etc. This is how it looks like now. Last 4 years, I've been building VASP in Europe, and to open remittance corridor to each new country, I was always picking up the new partner, integrating the API separately to make it the most efficient as I can, and my roadmap for the next year was packed only with integrations. I'm, as a founder, desiring to build best fintech for my best clients. Instead of that, to open corridors and move business forward, I need to integrate APIs. It was hell a lot of hassle. It was looking the same time for the Swift 50 years ago. Swift resolved that by bringing on the same messaging. So we're right now in this pre-Swift moment for stablecoins. It hasn't happened yet, but it will happen. And what I like to say that if Swift would be invented today, it would be chain agnostic, stablecoin agnostic, fiat agnostic, and travel rule and compliance will be embedded on the level of DNA of such technology. So when we have noticed this problem basically more or less a year ago, me and our advisors from KuCoin, chain analysis, etc., we started to think, how could system look like in the future? What was the precedence before? And what are the bad things that we dislike about the Swift? Yeah, by the way, we were using Swift for the last 50 years, and everyone was super happy. It changed the world of operating, how finance has been operating. And only within the last 5 years, after seeing Visa Direct efforts and such like payment networks and also stablecoins, we started to complain, oh, Swift is too expensive, oh, Swift is too long, but it was serving good for the last 50 years. And in front of us is another, I don't know how many years, but probably like decades, where systems should look different way. And in the Swift, for example, one of the problems where we have started is, maybe you faced that, I've been in this situation, multiply time, I can send someone of you 5,000 euros or dollars through Swift. Let's say I would be from the emerging market, you will be from the developed market. What will happen after this, your bank will receive it. It will be blocked. Then they will call you and say, hey, Mr. Anton, who is this guy? Why are you receiving money from them? So bring the papers and prove that you are the good guy doing the good job. You're preparing the papers, you're giving it to them, they take in another week to process the decision, then they decline transaction and send it back. You have your money back in 1 month, approximately. That's pretty standard situation. So where we have started is policies. Basically, each compliance officer, each regulator is free to set up how he likes to get money. From which geography, from which fintech, under which compliance level, at which volumes. So I like money from South Africa in any amount. I like money from Ghana from any amount. If we're taking some highly risk country, only to a certain amount. So this is always in the hands of the recipient to set it up. And we're doing the pre-flight check, if it is a green light or red light, if transaction will pass or wouldn't pass. Another thing is that as I've been mentioning, there is a fragmentation in terms of how many chains and stablecoins do we have. So we've understood that there is already existing will that's been invented. It's called correspondent banking. It's able to swap the liquidity from different countries between different financial institutions. So in the middle of the solution that we're trying to establish right now is this swapping, cross-chain, cross-stablecoin. So you can fit only to your preferable liquidity, preferable chain and preferable stablecoin, and we will do the rest of the connectivity. Another thing is, before transaction will actually happen, we will move travel rule data. So we will exchange the data, who is a recipient and who is a beneficiary. And we're bringing on privacy and reversibility. Privacy because transaction being cutted in a centralized way from different chains and different stablecoins. So even if you look into Etherscan, Solscan, you wouldn't be able to match the start of the transaction and end of the transaction. Another thing is that we bring reversibility, because on top of all of it is all the wallets that are participating in the mesh are being managed by licensed financial institutions. And it means that we can simply do a recall. Yesterday, there were panelists who were basically saying, hey, there is not such a thing as reversibility on the blockchain. But I don't think that it is a good thing to have, because at the end, blockchain is good in the speed and efficiency of costs, but we need to adapt it to the current financial frameworks and what all CTOs and CFOs basically desiring. One thing on top that we are actually bringing, as mistypo with this wallet, Web3 wallet's been invented for the machines, for the smart contracts, for the computers. I'm not good at memory as my computer, but we're all good enough to remember the phone number or nickname of the Instagram person, etc. And this level of abstraction of the wallets is what being one of the most hidden trends in the fintech. It's been adopted by Revolut, Wise, exchanges, etc. So we're bringing those human-readable addresses on top of the wallets, and it means that when entity X and user X would like to send money to another user, it's just enough to type their nickname, send the money that they have. It might be only one liquidity pool. We will convert all of this and bring it another chain. We will give you compliance data, and we will give you like the traceability backward for the regulator, so you can say who was John and who was Doe when money has been transacted. And this is like how interface then might look like. You just type in my name, saying I want to send $1,000 on Tron, and the API do the rest. So basically what we're trying to push right now, we're saying don't build integrations, join the networks. It was always the most efficient way to do that. Protocols that are unifying that is the most efficient way. So instead of many deals and many APIs, just one connection. Travel rule is inside. It's cheap, efficient, and brings you like many more corridors because they would be able like to scale. And the reason behind because I'm here is actually we're aspiring to build a world where like global money movement as simple as messaging, because this is the best user experience we can have right now, and I think we'll definitely will head right now there in the next 3-5 years. So, and money definitely should be compliant, instant, and accessible to everyone, so economic inclusion wouldn't stay a buzzword like it was for the last 5-10 years. Thank you for everyone. I'm here to find partners, regulators, to open discussions, because I think that unified framework is super important. You can scan the QR code where you can get my contacts. We'll be happy to talk during today. Thank you, everyone.